Friends, examiners often ask for partnership capital accounts to be displayed in this manner. So please look carefully, focus on whatever we are doing at this time. Do not pay attention to anything else. If anything else is distracting you, forget about it, focus on this. So when you go to exam, this is the format that you will use. Alright, so first thing you do, remember that this side is the what? Debit side. This side is the credit side. Alright, so first thing you do is you write the date, details, Taylor, Clark. Know that date, details, and then you have Taylor and Clark. This side is what? Credit side, and this side is what? Debit side. First thing that we do is make our entry of the capital. So when you credit the capital account with bank, because money went to the bank. So Taylor invested what? $2,000, while Clark invested what? $6,000. That's that for that one. Secondly, we're going to debit the capital account with the cash drawings, which is $2,000 each, as I said before. Then we're going to debit the capital account again with the interest and drawings from the profit and loss appropriation account, which is $50 and $100 respectively. $50 for Taylor and $100 for Clark. After which we're going to credit the we're going to credit the capital account with interest on capital from the profit and loss appropriation account, which is $100 for Taylor and $300 for Clark. We're also going to credit the salary, the capital account with the salary of $500 for Clark. Now friends, please note something about the salary now. You see, in this case, notice that Clark's salary was not given to him as such. It is merely credited to his account. If in fact it was paid in addition to his drawings, the $500, if the salary was paid to him in addition to his drawings, the $500 cash paid would have been debited to the current account. So this should have been debited to the current account, not the capital account. Remember the current account that we did before, this $500 would have been debited to that account, but it would still be credited in the capital account. Alright, that was something of information for you guys. Next and last but not least, we credit the capital account with the share of profits, $2,550 for Taylor and $1,700 for Clark. Then we add up everything and then we subtract the smaller from the bigger, and then we get these balances. So they are those are the balances, my friends, that we come up to. In accounts, the keeping of fixed capital accounts plus current accounts is considered preferably to fluctuating capital accounts. That means accountants prefer to use fixed capital accounts plus current accounts than to use fluctuating capital accounts. When partners are taking out greater amounts than the share of profits they are entitled to, this is shown by a debit balance on the current account and so acts as a warning. I repeat, when partners are taking out greater amounts than the share of profits they are entitled to, this is shown by a debit balance on the current account and so acts as a warning. So this is how the capital account is done in columnar fashion, and this is what examiners will require. Whenever you are doing any question, unless they ask you to do it in use separate accounts, you do it with the columnar format. I guess you understand that, my friends. The keeping of fixed capital accounts plus current accounts is considered preferred relate to fluctuating capital accounts. Therefore, fixed capital accounts plus current accounts are preferred to fluctuating capital accounts. When partners are taking out greater amounts than the share profits they are entitled to, this is shown by the debit balance on the current account and so acts as a warning. Now look at the balance sheet. We can look at the capital and liabilities sides only of the balance sheets for Taylor and Clark at this current moment. We're going to use both fixed and fluctuating capital accounts to look at it. Now first look at the fixed capital account. Capital is what? For Taylor is what? $2,000 and $6,000, and then you add up everything with $8,000. And then we're gonna have our current account afterwards. And a Taylor we're gonna have $100 and $2,550. This is coming from the current account that was done before. And the Clark you're gonna have $300, $500 and $1,700. We know that add up everything now. Then if afterwards add up everything right here. This is a format to show you how to construct the balance sheet for a partnership. I've add the drawings plus the interest and drawings and then subtract it from the share of profits. We get $600. In this case, we're going to also add the drawings plus interest and drawings and subtract it from the share profits. It's $2,500 and we get $400. And then we add up the 600 and the 400 to get $1,000 and subtract it from, they add it the $1,000 to the $8,000 to get an amount of $9,000, after which we place our double line right here, double line right here as well, and double line right here as well. So that's how the fixed capital on the balance sheet would look, my friends. Capital first for each different partner, then you add them up. Then you have the current account, Taylor, two different partner. Then you add, you have two columns right there. And you add them up. And let me draw the column for you to ensure that you know what you see what I'm really doing. To ensure that you see what is taking place right here. Now that's it, that for the fixed capital account. So you have first, so notice that interest and capital, they are on the normally on the what, which kind of side, which side they are on normally? Current account, they are on the what? Credit side, right? Yes. So and in the current account we realize that the credit side was more than the debit side, and it's the same case here. So this is more than this. You get the same thing. So whatever is in the current account by itself is the balance sheet as well, because the 600 is a balance carried down or balance brought forward, right? So 600 and 400. So if this balance sheet doesn't equal to what they get in the current account when you would have drawn it up, therefore whatever you are doing is incorrect. Next, look at the fluctuating capital account, how it is done now. So in this case now we have capital first, the top, Taylor and Clark, because this the fluctuating the fluctuating capital account is done like this normally. So cash introduced is what? 2,000 for Taylor and 6,000 for Clark, and the interest on capital is 100 for Taylor and 300 for Clark. Salary 500 for Clark, and then share of profits is 2,500 for Taylor and 1,700 for Clark. And we add up everything just like in the columnar format that we did a while ago, and we get 4,650 for Taylor and 8,500 for Clark. Then just as we did before at the top with the fixed capital account, we would add up joins and interest on joins and subtract it from the share of profits. No, from the amount right here. Same thing right here. Add joins and interest on joins and subtract it from the 8,500 to then they have 6,400. So these are the balances that you saw before already when we were doing the capital account when we doing the fluctuating capital account in the columnar format, and everything goes back to what? $9,000. So the fixed capital account is 9,000 and the fluctuating capital account is 9,000. Both of them are 9,000. So therefore, this what we are doing is what? Correct. However, if one current account had finished in debit, for instance, if the current account of Clark had finished up as a $400 debit, the abbreviation DR would appear and the balances would appear net in the totals column. If the net figure turned out to be a debit figure, then this would be deducted from the total of the capital accounts. So that's it, my friends, for partnership accounts.